Welcome to the deep dive. Today, we're plunging into a really fascinating set of documents, the shareholder letters from the Fundsmith Equity Fund for 2022.
hmm
This deep dive is all about understanding how a major investment fund navigated what was, well, a truly tumultuous year.
It certainly was.
We'll look at what immense economic forces were at play and, what timeless insights its manager offers about long-term investing. We'll even touch on some surprising, maybe even uncomfortable truths about corporate accounting and shareholder engagement.
Yeah.
Our mission, as always, is to extract the most important nuggets of knowledge and insight from these sources, providing you with, hopefully, a shortcut to being truly well-informed.
It was definitely a year that tested a lot of investment strategies, that's for sure. And these letters offer a remarkably transparent look at how one prominent fund manager sees things. Market dynamics, company quality,
Right.
and even those often overlooked nuances of financial reporting.
Yeah, those are key.
And what's truly fascinating here is how the specific performance of this fund connects to much broader economic shifts and, fundamental business principles. There are lessons here that extend far beyond just this one portfolio, I think.
So let's dive right into the numbers then. The first half of 2022. The Fundsmith Equity Fund saw a total return of minus 17.8%,
Oof. Yeah.
while its benchmark, the MSCI World Index, fell by, well, a slightly less severe 11.3%. So what exactly was driving this significant downturn in global equity markets?
Well, the primary cause was pretty clear, actually. It was that sharp surge in inflation,
Right, inflation was everywhere.
which made it absolutely necessary for central banks to start, aggressively raising interest rates. And this, in turn, just escalated the risk of a recession.
A nasty company.
It's a truly challenging combination for investors. The fund manager, he wryly compared it to soccer manager Tommy Doherty's quote,
Oh, yeah.
"When one door closes, another slams in your face."
Huh, yeah, feels like that sometimes. And this raises a critical point. What if we face stagflation? That dreaded combination, persistent inflation alongside a stagnant economy, maybe even recession. We haven't seen conditions quite like that since, what, the 1970s?
Yeah, it's been a while.
And what's truly striking is the historical echo here. Thinking about stagflation, I was fascinated to see the fund manager point to 1974. UK inflation, measured by CPI, hit a jaw-dropping 24.24%.
24%? Wow.
Yeah. Back then, boosted by the Arab oil embargo, this time it's the Russian invasion of Ukraine having a similar disruptive effect on commodity prices.
Right, energy, food.
So what are the core implications for us today?
Well, raising interest rates is, it's necessary to try and quell demand, but it's a blunt instrument,
Hope so.
especially when the inflation isn't primarily caused by demand, just running way ahead of supply. As former Bank of England Governor Lord King of Lothbury observed, today's inflation was largely sparked by a misdiagnosis back during the COVID pandemic in March 2020. Attempts were made to stimulate demand, QE, quantitative easing.
Right. Printing money effectively.
Yeah, central banks injecting money by buying bonds. But the real issue wasn't demand. It was a lack of supply.
Ah, the supply chains.
Exactly. Disruptions in energy, fertilizers, plastics, metals, microchips, even labor. The Great Resignation, travel restrictions, all that.
I see.
So raising rates won't magically fix those supply problems. It might take considerable time and maybe very high rates for demand to drop enough to finally moderate prices.
So the tools don't match the problem perfectly.
Precisely. When economic issues stem from supply-side shocks, demand-side monetary tools, well, they have limited immediate effectiveness, and they can lead to prolonged pain.
Okay, let's unpack that. Given these tough macroeconomic conditions, how does Fundsmith actually position its investments? What's their defense against inflation's fundamental effects, particularly on company profitability?
Right, so from a fundamental perspective, the best defense against inflation causing an increase in CAGEs.
Cost of goods sold, yeah.
Right.
The direct costs.
Is having a high gross margin.
Okay.
That's the percentage of revenue left after those direct costs. Basically, how much profit a company makes on each sale before overheads. The companies in Fundsmith's portfolio, on average, had a gross margin of 60% last year.
60%. That sounds high.
It is significantly higher compared to maybe 40% for the average large listed company.
Wow, okay.
So this means if their COGS rises by, say, 10%, it has a much smaller bite out of their overall profitability than it would for an average company with a thinner gross margin.
That makes a lot of sense defensively, but does that strategy ever limit their upside, say in a booming market when lower margin stocks might surge?
That's a fair question. It potentially could limit some upside in certain very specific market conditions, yes, but the strategy is about long-term resilience.
And on the flip side, can you give us a concrete example of how low gross margins really create problems?
Absolutely. Think about the U.S. retailer Target.
Oh.
Fundsmith would never own a stock like that, and you can see why. In Q1 2022, Target saw its gross margin contract. It went from 30.0% down to 25.7%.
Ouch. What caused that?
A perfect storm, really. Inventory write-downs, lower sales than expected, higher freight costs, ongoing supply chain issues, increased wages.
Right, all hitting at once.
Yeah. And their operating profit declined by a staggering 43%.
43%.
It just vividly illustrates how dangerous that combination of low gross margins and high fixed costs can be when conditions tighten up.
Okay. So despite these big macro challenges, what about the underlying business performance of Fundsmith's companies in that first half? Were they holding up okay?
They actually continued to deliver, well, surprisingly decent underlying performance. Take the portfolio's weighted average free cash flow per share. That's the cash a company generates after all its spending.
The real cash.
Yeah. It ended June 2022 actually 4% higher than in December 2021.
Well, even in that environment.
Yep. Which is equivalent to an annualized growth of about 8%. And revenue growth was also strong. Bordering on very strong for some companies, you saw two-year top-line growth figures like 48% at Adobe, 66% at Alphabet, 79% at Intuit.
Impressive resilience. And which sectors does Fundsmith primarily invest in, given this focus?
They mainly stick to consumer staples, healthcare, and technology, with some exposure to consumer discretionary as well.
Okay.
These sectors are generally expected to fare better in a recession compared to the more cyclical sectors, like industrials or materials.
Right, those get hit harder.
Yeah, they have higher fixed assets, higher costs, and their profitability tends to be lower and much more volatile during downturns.
So it's clear rising interest rates fundamentally impact company valuations. This leads us to, well, something fascinating you mentioned earlier. How does this affect those highly rated stocks? And which ones suffered most in Fundsmith's portfolio during that first half?
Right. So in a period of rapidly rising interest rates, long-dated assets tend to fare worse.
What do you mean by long-dated assets here?
Equities that discount profits or cash flows far into the future. Basically, stocks people buy, expecting high growth, way down the line, particularly those trading at higher price-to-earnings ratios or PE ratios.
Because future earnings are worth less today when rates are higher.
Exactly. The discount rate goes up. And Fundsmith's portfolio wasn't exempt from this effect, despite the quality. The 5 biggest detractors from their performance in the first half of 2022 were PayPal, which knocked off 3.0% alone. Then Meta Platforms, minus 2.3%, IDEXX, also minus 2.3%, Intuit, minus 1.5%, and Microsoft, minus 1.2%.
A lot of familiar names there, mostly tech-related.
Mostly, yes. And it's worth noting that PayPal and Intuit also had some, let's say, self-inflicted wounds exacerbating their situation beyond just the macro picture.
Okay. Now, there was so much talk during that period about a rotation, from growth stocks to value stocks. Did Fundsmith miss out by not owning more of those supposedly cheap value stocks?
Well, the much-hyped rotation was, frankly, rather underwhelming in practice.
Really? How so?
Let's look at the U.S., the S&P Value Index. It fell 12% in the first half of 2022.
So it still fell.
Right. While the S&P Growth Index declined 28% and the NASDAQ fell 30%. So yes, value fell less, but it was still very much a fall, not a gain.
Okay.
The fund also largely avoided sectors they typically wouldn't own anyway, like S&P Banks, down 25%.
Ouch.
And S&P Airlines, down 22%.
Yeah.
Both performed poorly. However, they did miss out on the energy sector. That was the one place to be.
Ah, right. Oil prices spiked.
Yeah. The S&P Energy Index was up 29%, BP up 17%, Shell up 34%. Fundsmith doesn't typically hold those.
It did. The fund's free cash flow yield that measure of how much cash a company generates relative to its share price.
Right. Valuation versus cash generation.
It increased from 2.7% at the end of 2021 up to 3.6% by June 2022. It ended the full year 2022 at 3.2%.
So what does that mean in historical terms?
It essentially means the portfolio's valuation declined all the way back to where it was at the end of 2017. Wow, a 5-year reset on valuation.
Pretty much. And what's notable is that by year-end 2022, the portfolio's FCF yield, at 3.2%, was roughly in line with the S&P 500's median FCF yield of 3.4%.
That's fascinating because the narrative, the story we always hear is that tech stocks are super expensive, highly rated. Has that perception really flipped?
It's captivating how that narrative is almost completely flipped, at least by this measure. Consider this. The median FCF yield on the 78 tech stocks in the S&P 500 is actually 4.6%.
Higher than the overall market?
Higher than the S&P median and higher than the 3.8% median SCF yield for consumer staple stocks.
So tech is cheaper than staples based on free cash flow yield?
On that metric, yes. Technology stocks are now more lowly rated than consumer staples.
Hmm.
But, and this is crucial, you have to distinguish between different types of tech.
Right.
There were those speculative tech stocks with, giant market values, little or no revenue or profits.
The meme stocks, the concept stocks.
Yeah, like maybe stuff in the Arikey Innovation ETF with NAPEs or average PEs of 53 times earnings. That's very different from Fundsmith's tech holdings. They hold established profitable companies, Microsoft, Adobe, Alphabet, Meta. Their tech holdings average a PE of around 24 times. Very different beasts.
Got it. Okay, zooming out to the full year 2022, the Fundsmith equity fund fell by 13.8%, compared to a 7.8% fall for the MSCI World Index. So, underperformance for the year. Let's connect this to what the fund manager calls the end of a long period of easy money. What exactly defined this era? What was it?
The end of easy money. This era basically involved large government fiscal deficits and, crucially, artificially low interest rates.
Yeah.
You can trace it back quite a way, really, even to the Greenspan put in the 1990s.
The idea the Fed would always step in.
Yeah, the idea the Federal Reserve would bail out markets during downturns. But it really escalated with the dot-com meltdown in 2000, and then especially the credit crunch of 2008-09.
Yeah.
That led to extreme measures like QE, ZRRP.
Zero interest rate policy.
And even an IRP, negative interest rate policy in some places.
Unprecedented stuff. And what were the hidden, maybe insidious problems that this easy money policy created over time?
Well, the biggest hidden problem, the fund manager argues, is that it leads to widespread bad capital allocation.
Meaning?
Meaning money gets poured into unproductive or unsustainable businesses. Simply because the cost of borrowing is so low, it masks weak fundamentals. These bad investment decisions then get exposed as the tide goes out, to use that famous Warren Buffett analogy.
Right, when the easy money disappears.
Exactly. We saw it in Japan with zombie companies back in the late 80s, businesses kept alive only by cheap credit. We saw it in the dot-com era, money raised for just an idea, not a real business, though, real businesses like Amazon did survive that bust and eventually thrived enormously.
Sure.
And in the credit boom bust, we saw those complex financial products structured to look like AAA credits when they were really triple Z.
Yeah, the subprime crisis.
The core insight is that cheap money distorts the real economic signals. It allows unproductive stuff to persist and grow, only to collapse later when reality bites.
And then, just when you thought things couldn't get more complicated, the pandemic hit.
Yes, exactly. So in 2020, central banks reacted with just an almighty stimulus via QE. Despite there being no fundamental problem with demand initially, or the banking system itself, the issue was people being locked down, supply chains seizing up. Then came the subsequent Russian invasion of Ukraine, hitting prices of crucial things like oil, gas, cereals. It was almost like Sod's corollary to Murphy's Law hitting right after all that stimulus.
Perfect storm.
The result, a rapid, painful upsurge in inflation and an abrupt end to that easy money era. And that swiftly exposed all those unwise investments, leading to collapses like the crypto exchange FTX and the meltdown of many tech companies with no profits or cash flows to back them up.
Right. So the fund's list of top detractors in 2022, Meta, PayPal, Microsoft, IDEXX, Amazon, many are often just broadly labeled tech. This brings up that question again. Is Fundsmith accidentally becoming a tech fund?
It's a persistent misconception, and the fund manager addresses it head-on in the letters. While 20.7% of the portfolio is classified as technology by MSCI, that's actually down from 23.2% back in 2014.
Well, interesting. So the allocation has decreased.
Yes. And what's really important here is how they define tech. Many stocks in the MSCI technology sector that Fundsmith holds, like ADP for payroll, Amadeus for travel reservations, Intuit for tax software, PayPal for payments, Visa for payments.
Right.
In Fundsmith's view, these are not primarily technology companies. They are service businesses that use technology effectively to deliver those services.
It's a tool, not the end product itself.
Exactly. And when you look at the combined holdings of what people typically think of as big tech, Alphabet, Amazon, Apple, Adobe, and Meta, That amounts to only 9.0% of the portfolio, which is actually less than they're holding in Microsoft alone at 7.6%.
Okay, that puts it in perspective. So what are the implications then for the future of these kinds of tech stocks in the current economic environment?
Well, these technology-enabled stocks, they do face some fundamental headwinds. There's likely a slowdown in spending after that massive digitalization push during the pandemic years.
People bought all the laptops and software they needed for a while.
Kind of, yeah.
Yeah.
And there's also the inherent cyclicality of tech spending and online advertising, which can be sensitive to economic downturns.
But you mentioned a silver lining.
Yes, this pressure might actually cause some of these companies to become more focused, to stop less promising projects outside their core, highly profitable businesses, like Alphabet shelving some of its other bets, or Amazon pulling back from ventures like India food delivery, or Meta maybe cutting back on metaverse spending.
Trimming the fat, focusing the core.
Exactly, which could actually be a net positive for their long-term profitability and efficiency.
Okay, so we've covered the macro environment, the fund's holdings. What does this all mean for Fundsmith's famous unchanging investment strategy? They describe it so succinctly. Buy good companies, don't overpay, do nothing. Let's unpack the first part. Buy good companies. What does that mean in practice for them?
Right, good companies. For Fundsmith, that means businesses with consistently high returns on capital and strong gross margins. We touched on margins earlier. For 2022, their portfolio's weighted average return on capital employed, or ROCE.
A key measure of profitability versus investment.
Yeah, very key. It was 32%, which is significantly higher than the S&P 500's 18% and the FTSE 100's 16%.
It's a big difference.
Huge. Gross margins were steady at 64%, again way above the S&P at 45% and FTSE at 42%. And these companies are also incredibly established. The average founding year for companies in the portfolio was 1922.
Wow. So on average, over a century old.
Collectively, yes, which speaks volumes about their enduring business models and resilience.
And despite that tough year, 2022, how did these good companies fare in terms of actual growth?
Well, the weighted average free cash flow grew by 1% in 2022.
Only 1%. That sounds low.
It is the lowest rate recorded for the portfolio to date, and it definitely reflects those challenging macro conditions we talked about. However, you have to compare it. The S&P 500 overall, its free cash flow actually fell by 4% last year.
Okay, so relative resilience again. Flat is better than down.
Exactly.
Okay, next part of the mantra, don't overpay. How do they measure that? How do they know they're not overpaying?
They primarily look at that free cash flow FCF yield we discussed earlier, valuation relative to cash generation.
Right.
The portfolio's weighted average FCF yield ended 2022 at 3.2%. And as we noted, that was roughly in line with the median FCF yield on the S&P 500, which was 3.4%.
So despite the higher quality, higher margins, higher returns,
Right.
the valuation based on FCF yield was similar to the average company.
Exactly. Which indicates that by their preferred measure, they aren't paying a significant premium for that quality.
Okay. And finally, the most intriguing part, perhaps, do nothing. What does that really mean for how the fund operates and its costs? Is it just about being lazy or passive?
Haha. No, definitely not lazy. Do nothing doesn't mean being passive in the sense of not thinking. It means minimizing portfolio turnover.
The buying and selling.
Exactly. The rate at which they trade stocks.
Mm-hmm.
In 2022, their turnover was 7.4%.
Is that high or low?
That's a little higher than usual for them, but it's still remarkably low compared to most actively managed funds. And this discipline, this low turnover, helps significantly minimize costs for their investors. They make a point of highlighting the difference between their ongoing charges figure, the OCF.
A standard fee disclosure.
Right, which was 1.04%, and their total cost of investment, or TCI. The TCI includes all dealing costs, stamp duty, everything.
Okay, so the true total cost.
Yes, and their TCI was just 1.05%. That tiny difference, just 0.01%, shows how minimal their trading costs really are. That contrasts sharply with funds that churn their portfolios much more frequently.
And importantly.
And importantly, the performance figures they report are always after all fees have been deducted. So you see the actual return the investor received.
Okay, so that do nothing is about discipline, low costs, long-term holding. But what happens when that do nothing approach, that long-term view, clashes with how companies actually treat their shareholders, or even how they report their own financials? This is where the letters take a truly fascinating, maybe even spiky turn into corporate governance and the well, hidden truths of accounting. The fund manager voices some really strong opinions on how long-term shareholders are treated versus new, noisy activists, using examples like Unilever and PayPal. What stands out to you there?
It's really quite striking. Companies often pay lip service, say they want long-term shareholders.
We love patient capital.
Right. But based on Fundsmith's direct experience, those patient investors frequently get ignored. Take Unilever. Fundsmith held shares literally since the fund's inception. They were the 12th largest shareholder.
Significant holding.
Very. But contact only really began when Unilever needed their support for a proposed headquarters move. There are serious concerns about the company's performance. Ignored. Only for activist investor Nelson Peltz of Trian Partners to buy a stake and quickly get a board seat, which preceded the CEO's departure.
Wow, so the squeaky wheel gets the grease?
It certainly seems that way sometimes. The pattern suggests long-term loyalty often isn't rewarded with influence, not until a more aggressive external force arrives.
And the PayPal situation, you mentioned that too. Was it a similar story?
Very similar, yes. Fundsmith identified problems early on. Things like lack of customer engagement, issues with cost control, acquisitions that seem to destroy value. They specifically suggested linking management pay more closely to return on capital. Sensible stuff.
Seems reasonable.
Disregarded. Until Elliott Management, another well-known activist, bought a stake. What happened next?
Yeah.
Elliott quickly got a board seat in an information-sharing agreement.
It really highlights the challenge, doesn't it, for even large long-term shareholders to actually influence management without resorting to public activist tactics.
It does. It raises questions about how boards genuinely engage with their committed owners.
The fund manager also dives headfirst into the whole purpose debate, especially regarding Unilever brands like Hellmann's Mayonnaise and Lux Soap. He offers a very direct critique there.
Oh, indeed. Very direct. He questions the actual utility, the business impact of these corporate purpose statements. For instance, Lux Soap's purpose is described as inspiring women to rise above everyday sexist judgments and express their beauty and femininity unapologetically.
Okay.
He basically says this confuses correlation with cause and effect.
Bro.
And he asks, quite bluntly, would Hellmann's Mayonnaise grow as fast, or maybe even faster, without all its virtue signaling?
He's questioning the bottom line contribution.
Yes. He's arguing that these statements often don't demonstrably contribute to core business performance and can sometimes feel like a distraction. He also highlights Unilever's extensive but often poorly disclosed acquisition costs and performance, like the Carver Korea acquisition, cost $2.3 billion. But it's barely been mentioned in annual reports since 2019, while its sales revenue has apparently declined significantly. Transparency issues.
That's a very pointed critique. But couldn't one argue that for some companies, a clearly articulated purpose does resonate with customers, with employees, maybe enhancing long-term value in ways that traditional metrics don't immediately capture?
That's a fair counterpoint. And certainly for some businesses, clear values and purpose are integral to their brand and success. Think Patagonia, maybe.
Right.
The fund manager's critique seems aimed more at potentially superficial or poorly executed purpose washing, especially when it seems disconnected from or even detrimental to core financial discipline and transparency.
Okay, so moving from purpose to the hard numbers. These shareholder letters also heavily criticize how some companies handle share-based compensation in their financial reporting. Why is this such a big deal for the fund manager? Why does he get so worked up about it?
He argues it's a huge deal because it directly distorts reported profits and therefore valuations. It obscures the true picture. It's especially prevalent in the technology sector, where giving stock options or shares to employees has grown dramatically. He points out that a significant number of companies, 45 out of 75 in the S&P Dow Jones Technology Select Sector Index, specifically remove the share-based compensation costs from their non-GAAP profit figures.
Okay, explain GAAP versus non-GAAP again briefly.
Sure. GAAP is generally accepted accounting principles, the standard rules everyone is supposed to follow. Non-GAAP figures are adjusted versions management presents, supposedly to give a clearer view of underlying performance. Supposedly. But by removing this very real cost of share-based compensation, these 45 tech companies effectively boosted their reported non-GAAP profits by about $26 billion in 2021 alone. just for that group.
$26 billion. That's not small change.
Not at all.
So what are the justifications companies typically give for stripping this cost out? And why does Fundsmith find them so problematic?
Well, companies offer several excuses. They often argue it's a non-cash expense.
But isn't depreciation non-cash? They don't remove that?
Exactly. Fundsmith points out depreciation is non-cash, but nobody removes that from operating profit. They also say its calculation uses assumptions. But again, so do many other standard cap items, like valuing inventory or pension liabilities.
Right. Accounting involves assumption.
They claim it's outside a company's control, but so are things like commodity prices or foreign exchange rates, which aren't typically removed. And the argument about double counting dilution, the fund manager says that only applies potentially to per-share metrics, not to the gross or operating income lines where they also remove it. The most nefarious excuse, as he puts it, is simply, well, everybody else does it.
Not a great reason.
Not at all. Fundsmith's core argument is clear. It's a real economic cost to shareholders, either through dilution, meaning existing shares are worth less, or because the company uses cash to buy back shares to offset that dilution, cash that could have been used elsewhere.
Can you give us a concrete example? Show us how this truly distorts a company's valuation for an investor looking at these adjusted figures.
Absolutely. Let's compare Microsoft and Intuit again.
Okay.
Microsoft's shares trade at a price-to-earnings ratio, PE, of about 25.0 times its consensus GAAP EPS, that's earnings per share, the standard accounting profit figure.
Standard PE.
Okay. Intuit, however, trades at 28.4 times its non-GAAP consensus estimates.
Non-GAAP.
Yes. And Intuit removes about $1.8 billion of share-based compensation cost from its non-GAAP guidance.
Okay.
Now, if you include that cost to make an apples-to-apples comparison with Microsoft's GAAP EPS, Intuit's PE ratio jumps to closer to 43 times.
Wow, from 28 to 43.
Exactly. So an investor just glancing at the non-GAAP number might think Intuit has a reasonable, maybe 14% valuation premium over Microsoft. But on a comparable GAAP basis, it's actually a staggering 73% premium.
That is a huge difference. It completely changes the investment case.
Completely. It highlights how these adjustments can mislead investors about relative value.
And this practice, it impacts cash flow reporting too, right? Because cash flow is often seen as a pure measure, harder to manipulate.
Yes, it does, and it's quite perverse how it works under GAAP. Share-based compensation, even though it's an expense, is paradoxically added back to net income when calculating cash flow from operations.
Add it back.
Because it's treated as non-cash. But this inflates the reported operating cash flow, and therefore the free cash flow figure that many investors rely on. Fundsmith argues strongly it should be reclassified. It should be treated as a financing activity, not an operating one.
Why financing?
Because choosing to fund employee compensation with shares instead of cash is fundamentally a financing decision. How you pay for things.
I see the logic.
And if you make this adjustment for Intuit, for instance, its trailing 12-month free cash flow yield drops significantly from the reported 3.5% down to a much lower 2.2%.
Again, a very different picture of its cash-generating power relative to its price.
A very different picture indeed.
And all this leads to what the fund manager has memorably coined fully diluted earnings per share. How does this distorted reporting then potentially lead to genuinely bad capital allocation, bad decisions by management?
It creates a potentially dangerous feedback loop. When management starts to believe their own adjusted profit figures, these fully diluted earnings, as he calls them, and they start focusing solely on whether an acquisition adds to or subtracts from these adjusted EPS figures, earnings dilution or accretion,
right,
rather than focusing on the genuine return on the capital they invest, they can make significant errors. Big mistakes. Intuit's $12 billion acquisition of MailChimp is cited as a prime example.
$12 billion.
$12 billion. For a price that was reportedly 12 times MailChimp's revenues, not its profits.
Wow, that's a high multiple on sales.
Very high. And this acquisition caused Intuit's overall return on capital to fall. It went from a healthy 28% in 2020 down to just 11% in 2022.
A big drop in profitability.
Huge. Yet the acquisition was likely presented internally and perhaps externally as not dilutive to those adjusted non-GAAP earnings per share figures.
Because the accounting obscured the real economic impact.
Precisely. The core insight here is that bad accounting isn't just a reporting issue. It can genuinely lead to bad business decisions, ultimately hurting long-term shareholder value.
What a deep dive this has been.
Mhm.
Seriously. We've covered everything from those immense macroeconomic headwinds of 2022, how inflation really bites into business models,
Mhm.
to
Yeah.
Fundsmith's resilient investment strategies, debunking those tech fund narratives, and digging into some truly, well, shocking truths about corporate accounting and shareholder engagement.
Yeah.
It's crystal clear that 2022 was, well, a very bumpy ride for the markets. But the core message from these letters seems to be one of unwavering confidence in their chosen companies, alongside a fierce, almost righteous critique of financial practices that obscure true value.
Precisely. Despite all the market volatility, despite the significant impact of rising interest rates, the fund remains confident that their portfolio companies characterized by that inherent quality, the high margins, the robust cash generation, they will not just survive, but ultimately prosper. As they emphasize, and it's such a crucial point for any investor to remember, sooner or later, share prices reflect fundamentals, not the other way around.
That's a powerful reminder. Fundamentals eventually win out. And finally, thinking about navigating tough times. As Winston Churchill famously said, if you are going through hell, keep going. So for you, our listener, here's a final provocative thought to maybe chew on. In a world just awash with information, with financial metrics thrown at us constantly, how deeply do you scrutinize the underlying business quality and the true accounting of the companies you might invest in? Beyond the headlines, beyond those easily accessible but often heavily adjusted figures, are you looking for the reality hidden beneath the numbers, or just accepting the adjusted story you're given? Something to think about.